Let's get straight into the conversation then around the numbers, around the provisions that you've reported this morning. Why is that number, do you think, bigger than the market was anticipating?
Yeah, let me just start to state that the credit quality of our loan book remains very, very strong. This quarter we have built up significant buffers, and in this way we believe it's the right one. We have been prudent in our provisioning, and we also create transparency to the market. We give a clear guidance to the market, and also restating that the credit quality remains strong. Then we have built up this buffer. As of now, we have a buffer of 650 million euro to cover for future loan losses, and that is just to cover for the different scenarios that can play out the rest of the year.
Yes, indeed. And let me talk to you about what you expect to see for the rest of the year then, because do I understand correctly that you're saying your full year provision for net loan losses will be below 1 billion euros? You've already taken some 850 or so. So does that mean you see very little extra provisioning necessary in the second half?
Yeah, that's correct.
That's correct. OK, and then moving on to fees and commission income, that dropped in the second quarter. What is the outlook for fees and commission outcome then?
Yeah, on our income lines, you can say that we actually income is basically at the same level as last year. So they are holding up well. Our net interest income increased by 2%, supported by quite good volume growth, especially in mortgage in all countries. Net fair value recovers. That is, we have seen that in the markets, and it is actually up 12%, mainly from improved trading activities. Then, however, our fees and commission, as you also state here, are impacted due to the lockdowns and the turbulence, and that's primarily from payment-related fees, advisory fees, and then of course the asset under management. But what we see is that the latter part of the quarter, the income from that part started to pick up. So that it's looking much better than the start of the quarter.
Can I ask about return on equity then, and help us understand how that number is coming out at 3.1%? Is there something? What is it that's making that so low?
That is the buffer we are making. So remember that we are making provisions of 698 million euro this quarter. That's a substantial amount. And what we are saying is that we are basically covering mostly of the expected full year loan losses. So that of course is having a big impact on the return on equity for this quarter. And then we are having a very, very strong capital base. We have a buffer of 5.6% to the requirement. So that is one of the strongest in Europe. So running with a strong buffer and then buffering up for potential credit losses for the future, that impacts the quarter.
And what about dividends, Frank? Do you still expect to make decisions on dividends in October? Are you hopeful of persuading the ECB around your ability to pay?
We have definitely the ability. As I stated, we have a very strong capital position. We have also stress tested and also through some very severe stress tests tested our ability to both continue to supporting our customers while we at the same time maintain our dividend capacity, and that has been reconfirmed. So we have the capacity, but of course we'll follow the recommendations. So I intend to follow the recommendations from ECB.
Just in terms of the overall picture for the regional economy in which you operate and for the Eurozone more broadly, Frank, we've seen the ECB meeting this week. We have a big meeting taking place of European leaders, of course, to talk about the fiscal recovery fund. From what you're seeing at the coalface, do you think big efforts, sizable effort is required from fiscal actors to prop up the European economy as a whole?
I think we need to divide it. So let's start with the Nordic economies. These are quite strong, and I think that what we are starting to see is the economies are picking up again. Although, of course, it has been a quite big hit that has been taken also in the Nordics, but actually it is picking up. When you look at the domestic spending and so in the Nordics, for example, using the PAP data, we are actually back close to index 100, so basically pre-COVID-19 levels. So that's positive. Then, of course, as smaller countries in an open economy, then we are dependent on how the rest of Europe, but also our trading partners outside Europe are developing. So that's too early to conclude on. And that is also why we are buffering up to meet all scenarios, not only the best one. But all in all, I think from a Nordic perspective, it looks encouraging, although it's way too early to conclude on what will the long-term consequences be.